You are listening to Keystone's Stock Talk Show, episode 324. It's great to chat with you again. This week, I kick off the show by revisiting a segment from a speech I gave over this past weekend at the VRIC in Vancouver, showing how per-share earnings growth is a key component in uncovering the next 10x stock. I note Hammond Power, Boyd, Expel, and Fearan Technology. Brennan reviews Graphene Manufacturing Group, symbol GMG on the TSX Venture, which he has reviewed for listeners in the past. He digs into what has helped the stock rebound from a significant drop from his 2022 highs. Brett answers a viewer question on D2L Inc, symbol DTOL on the TSX, a learning technology company which has dropped nearly 18% this year and over 40% over the past 52 weeks. Is the stock offering value? Is there something fundamentally wrong with the business? Brett will let you know. Finally, Rahil reviews Guru Organic Energy Corp, symbol GRGU on the TSX, a beverage company which produces, markets, and distributes natural, organic, and plant-based energy drinks. The stock has jumped over 340% over the past year alone, driven by strong revenue growth and a push to better profitability. Rahil lets you know the current valuations and whether or not the growth can continue. All right, gentlemen, let's get to the show. I welcome my co-host, the Killer Bees, Brett and Brennan, and our newest edition. I'm going to keep saying newest edition, Rahil. Welcome, gentlemen. It'll be 2 years in, and we'll be saying our newest edition.
Yep.
Rahil will be, when do I get some credit around here? Well, our listeners already gave Rahil more credit. They said he would beat us in the prediction show this year. So we'll see in a year's time if that works.
You probably will.
It keeps the pressure off me.
Yeah, it's true. Everybody likes the shiny new toy, right? Until you come up with something wrong, and then they'll all just have it. It'll happen.
Yeah.
What's going on?
I was going to say, let us know how the VRIC was. I hear that it was pretty busy this year.
So it's a metals and mining conference in Vancouver. Been around for 25 something years now. I'd say it was one of the busiest I'd ever seen it. I walked down the stairs on the opening morning, and there was a lineup to get in. I of course bypassed the line. I'm just kidding. Anyway, there was a lineup to get in. And it was buzzing around the event. I mean, it's actually was really no surprise to me. You see gold at record highs, silver at record highs, copper, what it's doing as well. And the metal sector was humming. At my lunch there, I'm sitting there, everybody's talking about financings. And so, you're just kind of listening to see what's going on. There is a lot of speculative excess in the segment. Maybe that continues over the course of this year, but I'd be cautious on some of the not the great producers that produce great cash flow. They're going to do well this year as long as prices are higher. But it's the junior mining companies, the companies that if this year's hot for mining, there'll be XYZ mining. If next year's hot for cannabis, there'll be XYZ cannabis. So those companies that are just really shells, that are just there their job is to raise capital. That's part of the business. And so be wary of those businesses. There are some companies that are actually exploring and trying to do good business out there, but it is one of the hardest businesses to actually create profitability over the long term. And so again, cautious on the exploration names that are there, but there were certainly good times and a lot of indications that there's a lot of money flowing into that segment right now. So it was interesting. Listened to a couple speeches, gave a speech. The room, it was great to see. The room was packed. There was standing room only, which is awesome. Took a lot of questions after. So anybody who came out to that event that we talked to, it was a pleasure talking to you there. And look forward to seeing many of you if you're in the Vancouver area at the World Outlook, which is just about a week and a half from now. Is it the 6th, 7th? Is that what it is? Or is it the 7th, 8th? Brennan's looking right now.
It is the 6th, 7th. It is
6th,
the 6th,
7th. I can't believe.
Yeah, no doubt.
Oh, that's Anyway, it's the 6th, 7th.
Just going back to, you talking about investing in junior exploration companies. I mean, it's just going against the
speculating.
It's just, yes, exactly. It's speculating.
I know.
even Pierre Lassonde, one of the, great names in the sector, has said that, you know, basically you're just throwing your money away in the space, and only one for every 1,000 projects actually will become a mine. That's what you're dealing with here. Um, it's a very, very, very tough way to invest. As Ryan said, it's speculating.
Yeah.
It's very tough.
It all looks good now, but if you really want to have fun with your money, you're probably better off going to Vegas and just putting all your money on either black or red and doing a spin of the roulette wheel. Again, it looks great right now, but I saw about 20 years of absolute dregs for that industry. So
Even
we'll
the
see
company
how
that I'm going over today, it's speculative, but I would tell you right now, I would rather, take a gamble or speculation in the company that I'm going over today than,
Well, that's a teaser, Brennan.
yeah,
So you're all in
exactly.
on this company you're talking about today.
No,
That's
definitely.
what I heard. I just heard that.
There
Book
was
that for
a
next year.
there was a YouTube comment saying that someone was refinancing the house, so that on this stock that I'm going to go over. So please do not do what that person
Seems like a
says
great
that they're
idea.
doing. Yeah, and before we get into the poll as well, I just wanted to remind people I did end up doing a little article on the website. Stablecoins, the picks and shovels play for the digital asset era. Again, I kind of went over this on the podcast, but go to our website, go to the blog, take a read through it. And as well, you can fill out the form at the bottom here and get our a report on the digital banking innovator that is leading some stablecoin innovation as well. We'll put the link in the bottom of this episode as well, so you can go right to the article there.
I see you've got Kevin O'Leary pictured on there as well. I just saw him leading into this podcast, standing behind and beside President Trump, standing behind Nicki Minaj, who was endorsing President Trump.
Yes,
quite the triumvirate there. It was pretty. Yeah, it was pretty.
Yes,
it was a pretty unique podcast or speech. Or she didn't even know. I don't think she was going to be talking. She's, I don't know what to say, but I love this man. Whatever she was backing. But it was an interesting little snippet that I saw right before. Came in here, and then O'Leary was just kind of smirking in the background. I'm not sure what he was doing there, but kind of just liking that picture you had there. Maybe it's just a canned shot of him that appears. But yeah, anyway, so that went on. The last thing I'll mention is the Seahawks. My Seahawks won against the Rams. Awesome, going to the Super Bowl 2 weeks from now. So I did my speech at the conference and then bootlegged it. A lot of people were going to the pub or the bars there and watching, and I'm like, it's so important to me. I had to watch alone in my room and just block out everything else. And I was losing it then. It was a great game, but it was awesome to see them get to the Super Bowl. So, and it's against New England. I'm sure everybody here remembers this, but they were, I think it was 2015 against New England, should have won the Super Bowl on the 1 yard line. Russell Wilson throws a pass instead of giving it to Marshawn Lynch and gets intercepted, and not two back-to-back Super Bowls for the Seahawks. New England won. Now they're back, and this is the revenge game in 2026. Not really. Different players, but same organization. So hopefully the Seahawks can come out with a win. That'd be great. All right, let's move to people actually want to hear.
All I was going to say is just every single time I hear you bring up the Seahawks, I just have a flashback to when you and I were in Vegas and we're watching the NFL draft, and I'm just like, Ryan, let's go and grab a bite to eat here. I don't care about the NFL draft. And Ryan looks at me and he's just, get some passion, Brennan. That's what he says to me.
Get about some something, Brennan. Get some and it was a lot louder than Brennan just said right now. What the hell's wrong with you?
It was funny.
I think I was kidding a little too.
Of course.
Brennan, but I know what Brennan does have passion for. It's finding great stocks. That's what he has.
Yes, sir.
For. That's how we bring it back to actually talking about investing, right?
Yeah.
That would be good. All right, let's get to that. There was a poll question we had last week. Which metals do you expect to perform?
Yeah. So on, since it's really been the theme for probably the last couple of months, high flying commodities. So just which metal do you expect to perform the best in 2026? Gold came in at 30%, tied with copper at 30%, silver followed by silver at 23%, and then lithium at 18%, which I'm actually a bit surprised that silver didn't do better, because that's the one which I've just been seeing more anecdotally on retail forums, so Reddit and the bull boards, that type of stuff. And then just in general media, it's just been very headline, probably just because it's setting such a rapid all-time high. Effectively every day I'm seeing it's a new all-time high, and that's same with gold. But silver has just been a higher percentage. It's been that effectively high beta play compared to gold. So I'm a bit surprised silver wasn't a bit higher, but I think it's just an interesting year for commodities, because it's just all-time high flying and pretty much across the board besides energy.
Yeah.
So
yeah, I mean, one of the things I heard at the conference was, and they kept using this term, is I'm all in physical. I'm all in physical. And I'm like, are you getting a physical? Is this medical related? Like, I knew what they were talking about, but just like the terminology there, I'm in physical. I'm in physical. I'm like, okay, are you hauling around gold somewhere? But anyways, it's just very physical. It was getting physical at a gold event. But,
Yeah.
and I heard a song, the song "Physical." You guys probably don't know what I'm talking about.
I know exactly which one you're talking
Yeah.
about. Yeah.
Isn't that like Olivia Newton-John or something like that? I don't know who it is, but that's all I heard in my head as everybody was saying physical. All right, let's move on. We might as well get to my segment. I'm
Yep.
going to do a little snippet from the segment I gave at the resource show over the weekend. And it's really not, it's about cash producing, cash flowing businesses, which is, nobody wants to hear about that there, but we're not going to sway from what we do best. So this was really one of my main takeaways, a snippet from a speech again I gave this past weekend, building on some basic tenets we use to find the next 10x stock. I highlighted another main criteria that we look at, and that takeaway that I wanted the audience to glean from our all too brief chat at that event was to buy great capital compounding businesses. Kind of sounds boring, but it's not, unless you do not like to create portfolio changing wealth. And this is an example of that portfolio changing wealth. Hammond Power, a great capital compounding stock. We recommended it at 60 cents. Today it traded at 168. I think it's 175 or something today, in that range. Again, the stock is up 28,000%. That to me is exciting. Other examples of Boyd up almost 10,000%, $230 to $222.22. That's a lot of twos. Expel going from $1.40 to the $54 range, 3,700%. And the most recent addition to our 10x club at Keystone, it's Fearin Technology. Here, this was just a couple days ago. It was 1509. I think it's 1650 today. So it's well into that 1,000% gain territory. So these are some excellent past 10x recommendations, examples of them. Well, Boyd is actually 100x. Hammond Power is now 250x stocks. These are investments that have dramatically altered the wealth accumulation in client portfolios. Now, our goal is not just to put these up because they make us look smart. I do appreciate that, but it's to find the commonalities in these great stocks and help them guide us to find the next 10x stop. So why not? I'm going to continue our chart parade here today and identify our first kind of one of our other commonalities that we use in these great 10x stocks. So let's look at kind of the share structure. Do they dilute continually over time? I'm going to start with Hammond Power here. It's been a recommendation for 24 years. Over this time, the company has increased its share count by under 6%. That's basically a rounding error per year. We see countless businesses that do far more than this, diluting 20, 30, 50, even 100% in a year. I'll give you an example, a company we just answered questions on from clients, but it's a company we did some research on over the past several years for those clients. The revenue growth was strong, but the share count is totally out of control from this business. It helped dilute shareholders into massive losses. The company Simply Solventless Concentrates, symbol HASH, a company we advised against investing in, has done the opposite of Hammond Power, managing to grow its share count by over 138% in 2 years. Massive dilution, making per share cash flow or earnings growth which powers per share or returns in the stock over the long term. And I'll show you that. It makes it very difficult. We saw how Hammond Power's shares have jumped over 25,000%. Any guesses on how Simply Solventless performed over the last year? Well, not surprisingly, the stock is down 78% in the past 52 weeks. Undisciplined growth kills stock returns. Disciplined growth without dilution powers truly great returns. So let's examine a couple more of Keystone's 10x recommendations if they match Hammond Power's example in terms of their disciplined approach to growing over time. In the case of Expel, in the 7 years since our buy, the stock count has increased 0.29%. So basically zero over that time. In the case of Fearon, in the 10 years since our recommendation, the stock count has gone up just around 9%. That's less than 1% per year. So this, another commonality that we like to add to our checklist to find these great 10x stocks is that they are disciplined in funding their growth. They do not dilute existing shareholders. They're mindful that if you continually increase the amount of shares outstanding, it's difficult to continue to produce per share earnings growth. It is per share earnings growth that drives stock prices over the long term. But let's show that as proof. Let's put up some charts to show the proof that earnings per share and growth in that drives it over time. So here's the big bold numbers to hammer to our audience over the head and let it sink in that this is a way to find the next 10x stock. One of the driving components will be per share earnings growth over the long term. I'm going to start in reverse order. Here you go. Fearon Technologies, 10x plus stocks. Fearon's growth in terms of EPS was 333% over the past 10 years. That powered over 1,000% return in the stock. If we look at Expel, the EPS growth since our recommendation, 469%. That powered a 3,700% return in the stock. If we look at the Boyd Group, a nearly 5,000% growth in EPS powers a near 10,000% gain in the stock. And finally, Hammond Power, over 18,000% growth in EPS fuels 2,800% gain in the stock. So 4 simple charts displaying the power of per share earnings growth over the long term. The higher the growth in EPS, the higher the growth in the stock. And we can see that with these 4 great capital compounders and a lower share count, that's the denominator here, that creates an easier environment to grow per share earnings. Growth without dilution works. Okay, that's a simple segment. I'm going to bring it back to the gentleman here, see if we've got any comments.
Yeah. I mean,
you're totally wrong. That's your first comment.
No, it's definitely not what I was going to say. But no, I think that's like just number one. That is what's driving a stock long term. I had a client, email me a few days ago on a specific oil and gas stock that we were looking at. He emailed me. This is a small business. It's too low for institutional investors. He was asking, can hedge funds invest in this company? And he put it in bold writing. He was like, I need a thesis on how the stock price can rise. He even said in brackets, he needs a thesis where there's going to be more buyers versus sellers. But it's just, that's overcomplicating. At the end of the day, if the company is able to grow earnings per share over time, the stock price will take care of itself. You don't need to, of course, if all of a sudden institutions start picking up coverage and start buying, of course, that's great. That's going to help the stock even further. Maybe it gets a re-rating in the market. But the bottom line is if a company over time is growing its earnings, the share price will take care of itself.
Yeah. Looking for a thesis is kind of going backwards versus having a thesis and then buying. And then the other thing is, throughout the examples Ryan gave, you can see how it's just incremental. It wasn't one big year or anything, which you'll see occasionally with some high flying stocks is they'll have a great year. It might have just all the tailwinds, great macro environment. They have some one-offs. Maybe they did an acquisition and then it plateaus after that or it declines. And then you have, it can't do this accretive EPS growth or free cash flow over time. And it falls back down. And that's a big trait, I would say, in those companies as well, is that consistency.
Yeah, is it sustainable, and then is it repeatable over time? Just it can compound and repeat that earnings growth over time. And if you notice in those charts, I mean, there was going pretty fast. There's periods in there, like in a 10-year period, where you can have a little bit flat. It may even dip a little bit, but then you have there may be something going on in the broader economy that affects the business, or it might be with EPS you can have a one-time number in a quarter or a year for a company. But if the growth is there and the company minds its share count, then you can produce per share earnings, and cash flow is really what we look at. But it's simple to put it up as EPS growth over time. That's going to drive a stock price. And at a conference like that I was just at over the weekend, where 90% of the companies there don't even have revenues, they're light years away from being in this category that we're, where we want to swing at when we get that pitch down the middle, to make a baseball analogy. We want to swing in that box where, we know that's our sweet spot. And part of that is, we need profitability to start, then you need growth in the profitability over time. And we know from studies, from our anecdotal, I like the data, to look at the data, and the data guides us towards this being the area where you want to be swinging. Start with profitability, grow that over time. And then, if you're wanting to find those returns that can power a portfolio long term, these are the elements you have to look for in those stocks. When you start to stray outside of that, the data isn't with you, anecdotal, but the data just isn't with you. Why not be in the sweet spot where you have a fighting chance at beating the market? And that's what we're going to continue to look at. And you have to be disciplined. It may sound, everybody's chasing metals right now. I've seen it. I've seen bulls in the market before for this, and it doesn't end up well 3-4 years down the road. So, I mean, there's good royalty companies. There's good, it's not like we don't have any exposure to this sector. I talked about Dynacor there. We just talked about that as a success story that we've been invested in 6, 7, 8 years. Oh, 6. Why 6, 7 come everywhere now? Anyways, that many years. But and there's drillers that you can buy. That is one thing that I see. It's a lag though. Like when I hear everybody there raising capital, some of that money goes to drilling, because they have to. You have to try to prove out a reserve, or whatever the hell they try to do as a business model. You have to do that. So there's probably some money coming in. It may still be 6 months plus out, but that money has to go somewhere if everybody's pouring it into that sector right now. All right, well, let's move on. Brennan, yep. I believe you're next on the docket. You're going to be talking about Graphene Manufacturing Group. You've talked about it at least once in the past. What is that you're drinking? The audience really wants to know.
Orange Gatorade.
Hold that up, and let's get some comments on what does that look like he's drinking. If there were some bubbles in it, we'd think you're having a beer. Who knows?
Yeah.
And there could be other things. Yeah.
So I think we're not gonna say what we said offline.
No. Thank God. Yeah. I think people can infer. All right, let's go.
So yeah, we have looked at this stock a couple times in the past, and it has recently jumped. The share price has recently jumped. So I thought that I would just dig into, what's driving the stock and look at the overall progress the business is making. So Graphene Manufacturing Group, GMG, on the TSX Venture, currently trading at a price of about $2.71, market cap of about $340 million. And they are a company which seeks to offer energy saving and energy storage solutions enabled by graphene. They're structured into a couple of segments. In their energy savings segment, which is currently the primary revenue driver of the business, they're focused on their Thermal XR, which is a graphene enhanced HVAC-R coating or energy saving paint, with distribution partners through New Calgon in North America and Bejer Ref in Australia. Probably not saying that right. As well as G Lubricant, a graphene enhanced lubricant additive that seeks to reduce fuel consumption and carbon emissions. G Coolant, a graphene enhanced engine coolant that seeks to improve the thermal efficiency of engines. And Supa G, their graphene slurry designed as a performative additive for batteries to increase conductivity and charging. And in their energy storage segment, GMG and the University of Queensland in Australia worked collaboratively with financial support from the Australian government and Rio Tinto to progress further research and development and commercialization of graphene aluminum ion batteries, including a coin cell and pouch cell battery. They are targeting, as well, this isn't a segment that's actually broken out, but looking at their actual graphene manufacturing, they're targeting manufacturing capacity of 10 tons per annum by mid 2026, which would be up from about 1 ton per annum right now. And their plant expansion is expected to be online by June of 2026. So they are trying to grow capacity here. So as you can see on the chart, the stock has had a strong run heading into 2026 due to some news flow, which we will dig into shortly, with the stock now coming back to above the price when I reviewed the stock back in January of 2023 at 229. But, each time that I looked at the stock, I indicated that the business is an interesting speculative story, but not investable in terms of our growth at a reasonable price framework. And of course, I love bringing this up. Every single time that I covered the stock, I got a lot of heat from listeners because, I didn't say that it was, the next best thing, the next great stock. We got anything from comments like that we get all the time, like, these guys don't understand the tech. One mentioning how GMG made the top gainers list over the COVID bull run, which literally doesn't matter at all. Who cares, that a stock made a run during one of the most euphoric markets out there? It became relatively dead capital when the euphoria wore off. I saw many stocks, during that time go from $1 to $16, and they now are stuck at 10 cents per share. So, that really means nothing. Someone else says, they're able to fundraise easily. Ask yourselves why. A company's ability to fundraise means nothing other than more dilution for current shareholders. And my fave is this one in the bottom right here, where they say, this stock's gone up 2,000% since, which we responded that no, it hasn't. It's actually been down 50%. And then this person said, I was thinking of a different stock when I said that, but was lazy to delete the comment when I realized. Oh, sorry, that one cracks me up.
That is ridiculous. That is impressive. Yeah.
Anyways.
At least they had a comeuppance there. At least,
yeah.
Or they admitted to it.
But, that's kind of like the comments that we get on these kind of businesses, because they are a little bit, cult stories. They've got an interesting technology. But, anyways, Ryan was already teasing, the stats here. I'm actually pulling it up again. We've pulled this up on the podcast many times before, but this study by Jenga Partners, which looked at the primary drivers of 10x stocks, or stocks that went up 1,000% over the past 10 years. And they found that 87% of all global equities that went up 1,000% or more over the past 10 years began as small to micro caps. 82% of those were profitable at the start of their ascent, and 91% had some history of profitability. So with this said, I've seen hundreds of story stocks flounder into absolute dead capital over time. Why would you want to play in the sandbox of companies which are money losing, potential disruptors, when roughly 90% of 10x stocks are profitable at the start of their ascent? I hope that GMG does well for those who own it, and it is able to commercialize its operations and trend into some profitability eventually and start self-funding. But it is not a name we want to own given the risk profile. Now, looking over at some operational updates here, on September 15th, they got their coding patent approval and case study success, where they announced that its Thermal XR enhanced heat transfer coating has been successfully patented in Australia for a period of 20 years. The company also is progressing with patent applications in various other countries. They also, on October 28th, they had a commercial milestone with Beijer Ref and Kirby. Beijer Ref has agreed to offer GMG's Thermal XR Enhance as an optional coating solution across its Australian network, including on Beijer and Kirby branded refrigeration evaporator coils. This agreement represents a commercial milestone for the distribution of their heat transfer technology. On December 15th, they announced graphene aluminum ion battery progress. And this was really one of the big ones that was driving the stock higher as of late, where they provided an update on its their battery technology there. And the battery technology has demonstrated the ability to fully charge in as little as 6 minutes. And as of 2026, the company is moving through the battery technology readiness levels with plans to test cells with customers throughout this year and target small scale commercial production by 2027. So they're looking for, potential commercial production for these batteries in 2027. And on December 22nd, they got their USA EPA approval conditions from the US. Approval conditions for their Thermal XR, which is also referred to as Cool Works in the US, which is, again, a milestone for commercialization of their graphene coatings in the United States. So that's kind of the news flow that's been driving the stock as of late. But let's take a look at the most recent financial results, Q1 of 2026, all in Australian dollars. So revenue is still minimal here. Analysts are really expecting to see revenue begin to flow into fiscal year 2027. So, we'll continue to monitor the business's progress till then and see if the revenue growth actually leads to profitability. Because as you can see, adjusted EPS was a loss of 3 cents per share compared to about a 3-cent loss for the same period in 2025. And adjusted EBITDA was also a loss. Now, the balance sheet did have about 13 million or 12.9 million in cash on the balance sheet with no debt, but the company has issued a lot of shares over the years to keep the lights on, and that's why, they've got this cash balance. So, as you can see here, they're now up to about 120 million shares outstanding with their last raise in September 2025, which was a bought deal at 90 cents per share. Which is supposed to help fund the major Gen 2 plant construction, which is increasing their graphene capacity. But I'll also note that the company opened an at-the-market or ATM agreement in July of 2025, where they can raise up to $20 million Canadian dollars over time by selling shares directly into the market at current prices. And this is to help with general working capital purposes. So clearly, the company is far from no longer being a diluter and funding through cash flow. So to conclude here, again, as I said last time, there is speculative potential, but the business is still a concept and far from meeting our investment criteria as it has no profit, continual dilution, and much to prove out still. If they can commercialize their battery and begin to ramp up their thermal coatings and lubricants, eventually breaking into profit and growing earnings per share and cash flow per share, yes, there is a case to be made that the stock has upside potential, but the business still has a lot of work to do. And revenue, like I was saying, is really supposed to ramp up in 2027. So we will monitor that progress. And like this comment from Blue Bpeng Glider he says, I will put money into this because of the potential bonanza, but only what I can afford to lose with a shrug. Now, I like that comment where, generally I see no problem taking a speculative bet with a teeny tiny portion of your overall portfolio capital, which you are willing to lose. But as we say time and time again, if you build a 15 to 25 stock portfolio comprised of stocks like GMG, over the long run, you are bound to do poorly. Remember, 90% of 10x stocks over the last decade were profitable at the start of their run. So, again, we'll monitor the progress from the business, see them kind of ramp up revenue. But again, we remain on the sidelines. Just too much risk at this time. We're looking for those asymmetrical, reward to risk kind of plays where, we're looking for much more upside and kind of a capped downside. As far as I see here, the stock could potentially go, way further down if the company is never able to, generate cash flow and they continue to dilute shareholders. So, that's just something that we want to avoid at Keystone.
Yeah. And I'm sure you'll continue to get some, nasty comments about this, but I think it's, it's part of our goal is to get that message out there. And it's not even really a comment on this company, Graphene Manufacturing specifically. It's about the strategy when looking for great returns over the long term. When you're buying these highly speculative pre-revenue businesses, you require massive potential gains to compensate for the massive risk. That's in theory. So my question would be, why take the risk when we just hammer this over the head with you? When the data shows 9 out of the 10 stocks that gain 10x returns, they come from profitable businesses. This is not the profile of the company that gives you the best chance of producing 10x returns. You're playing in a 10% sandbox versus the 90% sandbox. It's just not good strategy. So even if you're trying to take a flyer on a company like Fearon, take a flyer on a company like Hammond Power, take a flyer on Boyd, take a flyer on these Expel, these great capital compounding businesses that trade at low prices, low valuations that you're looking for and have the actual upside. I mean, and again, we're going to say it over and over and over again because the data backs us up and our own research and the companies that produce tremendous results back it up. So we're thick-skinned and willing to take all the flack that the cult of these type of stocks they have behind them, because you have to have that to raise capital over time. It's not even a comment, again, on Graphene Manufacturing. It's just what sandbox do you want to play in to give you a fighting chance to beat the markets long term. And we're going to keep hammering that you should be in the profitable box versus the non-profitable.
And just what you were saying with raising capital, and what Brennan brought up with the comment before is, what happens if they can't raise capital? Even through no fault of their own, we have another COVID, you have a recession, that sort of thing, is these companies can't survive without raising capital. So even if it's no fault of their own, companies operationally doing what they are meant to, but they're burning cash. That's the nature of a speculative business like this. It's still 2 years at very least before commercial production. It needs capital. If they cannot raise capital, it's going under.
And if there's an extraneous market event, like you said there, maybe the share price just drops precipitously and then they have to raise capital at such a low price that there's massive dilution. And then even if it actually becomes a great company and grows revenues, you're diluted to the point where, they're rolling back your shares. And, that I'm not saying any of that's going to happen. You have those risks. With the profitable business, like I'll go back to Fearon as an example. That company makes, printed circuit boards, cockpit assemblies in the aerospace industry is one part of its business. Well, COVID hit, the people weren't flying anywhere. The industry shut down. So that business, if they were pre-revenue, could have went out of business, but they had revenue, they had cash flow. They actually built up cash during that period and bought 2 other businesses that, went on sale because of what went on. But that's what you're able to do. A good business is able to do. And that powered them out of COVID. And the share prices have surged since then. But they've surged because what powered them is EPS growth. We showed that on the chart. So, I mean, you can see that in real time happening for a business because they have a good fundamental structure and a good solid cash flow, a balance sheet. Like anything, if you were going to buy, I could go on and on about this, but if you were going to buy a mom and pop pizza store down the street, don't even make it about the stock market. Like you'd ask, hey, Fred, who owns the pizza shop, let me see your bank account. Do you have cash in it? And if they had a ton of debt, you wouldn't want to buy it. Do you have a lot of customers coming? Are you profitable every year? It's the same thing we ask of these management teams. And it's the same thing that you should ask of any stock that you invest in. Are they creating capital? Are they creating growth on a per share basis? And is that going to power the investment going forward? It's very simple, but people kind of overcomplicate it, overthink things. And, you end up hurting your own portfolio. So.
And again, like you do get it. Sorry, I'm still hammering on it. Like you still get, like these cult stocks again, like, me and Brett were going through our YouTube analytics a few months ago, and we were looking at, the most disliked posts. Every single one that has that has, like the most disliked posts are pre-revenue, cash flow negative business story stocks. you know, that you get this group of people behind them that, you know, this has to be the next best thing. Look at Cielo Waste. You know, that's a business where people were telling me that it should be trading at $10. You know, it's the next best thing. You know, again, it's just, don't be in that sandbox. Come to the other sandbox where, again, 9 out of the 10, you know, that's where
I
you
mean,
find
you were telling me about Bed Bath and Beyond and
Oh,
how there's still people, you know, it goes bankrupt and still people that got in on it as a meme stock and think that their shares are still going to be worth something at some point. Like,
yes. I mean,
has it not gone completely bankrupt?
it's gone completely bankrupt. They've
Your
lost
equity
their
is
shares,
zero.
and their
Come to
equity is
grips with it.
zero.
But there's still a cult behind this.
But there's a cult behind it, and it's like me and Brett were even saying, it's sad to, you know, like actually like
Yeah.
look at, you know, like there's like mental illness, you know, like in this group where it's like, you know, they're convinced that their shares are coming back and they're going to make millions, you know, because of, I can't even remember, is it Roger Cohen or something along those lines? But anyways, that's a whole rabbit hole to go down.
It's a rabbit hole we won't even go down. But Brett, we might as well move on. We're going to talk about our viewer question, I believe, that came in on the DTOL or D2L Inc. It's a learning technology company. Interesting business that we follow. Questioning the growth going forward, but it is coming down in terms of valuations.
Yeah. D2L is a company we've covered on the podcast, I think 2 or 3 times before, and is one which we've had lots of client questions on over the years as well. And it's a pretty interesting company, and we have a monitor report in our upcoming Canadian cash rich report, which will probably be released around the same time of this podcast or not long after.
Yeah.
So D2L Inc. DTOL on the TSX, the provider of online education through a single cloud platform. The company serves over 18 million K-12 and higher education and corporate education users across North America, Europe, and Australia. Like I said, we have looked at the company a few times now on the podcast. And as well, we're featuring it in our Canadian cash rich report, which will be released around the same time the podcast. But the stock has declined by 29% over the past 6 months, with roughly 40% decline from its high, if you want to call it that, in October, down to $11.10, $608 million market cap. There has been a decline really across anything to do with software, from Constellation Software, which I covered not long ago on the TSX, as well as like big US names, Salesforce, CRM, Adobe, very unrelated businesses, but they've been hit as well. Some closer e-learning companies, Duolingo, Coursera, those sorts of companies, they've all been pressured. Effectively, anything across the software sector as a whole has been hurt valuation-wise. So it's not surprised even D2L, having still quite strong fundamentals, but we'll get into that, it was a bit weaker. There are macro narratives impacting prices and valuations. So the decline across the sector will likely have weighed on D2L, which is why I think we're seeing this recent decline, as software stocks in general for such a long time have been so richly valued, which we've mentioned in our prior segment. With D2L, that's one of the main apprehensions we've had about it, is it was just so richly valued. So this could create an opportunity if you do see many of these software stocks. Is AI a threat? Are the changes that people are fearing coming to fruition, or is it just a narrative that switched? It can create an opportunity. So let's look at the last quarter of fiscal Q3 2026. It wasn't great. It wasn't the worst thing ever, I would say, either, though. The figures are in US dollars. Subscription revenue increased 5.6% to $49.4 million. Professional services fell 38% to $4.7 million, with total revenue of $54.1 million. The big decline in service revenue was largely impacted by the one-off adjustment in the prior year, which increased it, but also a general slowdown in spend. So that is a macroeconomic headwind, which is a bit of a concern, but it is, of course, the smaller of the two revenue sources. But the more really impactful, at least to the share price, likely is the slower subscription growth. The dominant portion of the revenue seeing higher churn in US K-12. While the K-12 isn't really the core growth driver, the slowdown is still materially impacting the revenue. That said, higher ed and corporate is still relatively strong. In the earnings call, the company did mention it was one or two key clients moving to competitive solutions, as well as other clients moving to more legacy solutions, so things that you would have seen 10, 15 years ago. So whether this is a shift back to a more traditional ed tech environment, or it's just a temporary blip of, hey, our spending, our priorities have changed, or is this an actual long-term shift? If it is a long-term shift, that's obviously much more detrimental to the company. But if it's just this quarter or this year, then it can be an opportunity. ARR, annual recurring revenue, increased 6% to $213.4 million. $2 million of that revenue is actually from the company's AI offering, Lumi, which the company mentioned has a strong pipeline during the next investment cycle. So that this is one of those things with these software companies is AI is it a threat? Is it an opportunity? Right now, the market's really seeing it as a threat. Do you have these quick development times, introducing competition? Are companies just going to do it on their own, or is it just going to be new entrant, as well as it's just weighing overall on really the spend, wait and see type of approach? But excluding the K-12, ARR actually still grew at 10%, which was at the bottom end, though, at their medium-term target, which is 10 to 15% revenue growth. So bottom end, but it's still within the target. Adjusted gross profit fell 3.5% to $36.7 million at a lower margin of $67.8 million, as gross margin for subscription was impacted by planned migration of their database, having a 200 basis point impact. But those costs will scale down throughout 2027 and actually have benefits following that. Adjusted EBITDA fell 23.8% to $7.9 million at a 14.7% margin, slightly below the longer term expectations and the expectation for the year of 15%, impacted by the lower gross profit as well as the prior one-off last year. Similarly, net income fell 20.9% to $4.4 million or to 8 cents a share. So generally weaker financial results, but by no means disastrous. However, guidance was also slightly lower for fiscal 2026 is just one more quarter. I know 2026 has already come to an end. It seems like it just started. So subscription revenue, they're now expecting 198 to 199 million. That's an implied 10% growth, with the top end just clipped by $1 million from 200 million from their prior guidance. Total revenue lowered to 217 to 218 million, a 6% implied growth from a prior range of 219 to 221. So we're seeing both the bottom and top end overall shift down, and EBITDA trimmed off the high end as well, with a now expected range of 32 to 33 million from the prior 32 to 34. Guidance was lowered to reflect that K-12 churn and just weaker professional service environment as spending caution weighs on the company. The medium-term fiscal 2028 targets are the same still. So, 10 to 15% annual revenue growth, 18 to 20% adjusted EBITDA margin. So the company's not seeing a medium-term decline as of Q3 yet. Whether that shifts in the coming quarters, that is something which you will definitely want to keep your eye on. So they are well below still. They still need a few more percent on that adjusted EBITDA. But if you're looking at just the K-12 ARR growth, they are at least at the bottom end of that revenue, which it is annual, of course, and they have a bit more time to bring that EBITDA margin up to par. The balance sheet still superb, with a cash position of $110.5 million, $11 million in leases, and no other debt, which results in a net cash position of $99.4 million. Hence why it is in our cash rich report. It is cash rich. The company continues to look for M&A, which the last one was in summer of 2024. Share buybacks have been occurring, which the company was actively repurchasing as recently as December. I haven't seen any filings for January yet, though, as well as there can be organic reinvestment. With software declining it as a whole, it might actually be opportune time for some select acquisitions for a cash-rich company like D2L. That is actually the really big benefit of having a great balance sheet. You're capital flush. You don't need to go out and raise a lower valuation or raise debt. You can look for companies in the similar sector that are seeing the same pressures as you, and you can buy them at a cheap valuation. So on the valuation side, as the price coming down, so of your valuations, the company is trading at a trailing P of 15 times, a forward EV/EBITDA of 10.8 times, and a forward EV sales of 1.6 times, which is quite a bit below its longer-term average and recent averages. And I will note, just in October, their key competitor, which was years ago was a public company, Blackboard's parent company, Anthology, entered Chapter 11, which could actually create an opportunity for D2L to gain some market share. Whether or not that occurs, we'll just have to see in the coming quarters. That is not something which we can really see until the numbers arrive. So really, to summarize, put it all together, K-12, which is non-core to the growth, is creating some headwinds. The question is it just a blip, or is this a structural change to budgeting, or is it you want to switch to legacy ed tech? You don't want the online learning ecosystem to the same degree anymore. Is that going to happen, or is it not? The higher education and corporate growth remains stronger, growing at a 10% ARR, which is the low end of the medium target, with both higher ed and corporate adding clients in the prior quarter. The valuation has come down significantly with the share prices of the company, as the company did have a weak Q3, but not extremely poor, and overall software valuations have come down, which can provide an opportunity if we see continued pressure on valuations, despite at this time seemingly minimal impact on operations. And as well, the big pressure on software is AI, which they can in turn even benefit from. They do have their own AI offering, which they do state has a strong pipeline at this time. We are continuing to monitor the stock. It's in our cash rich report, but I wouldn't be against someone taking a more aggressive position in the stock. It's not an extreme situation, or not an extreme valuation or extreme risk at this time. And for disclosure, we have no position or relationship in the company.
No, I think it's a good summary. I mean, generally, we've been looking at the software sector, both small and large, and there's been significant declines. Some of it justifiable fears or just the market gets an unknown and it reprices based on, it doesn't like uncertainty. It takes the price or multiple that the market is willing to pay for a stock down. And you're seeing that in a lot of those names now. Our job is to figure out whether it's reasonable. What we do know is many of these SaaS or software companies were trading at such high valuations that even a 30% haircut just puts them into a range where it's a little bit more acceptable. Some of them are still expensive looking, taking a 30% haircut. So you have to be mindful of that. You see a company that really could have been trading in a reasonable market 50% below where it is to get to a starting point. So, I mean, I'm just saying generally, I'm not saying DTOL is doing that, but there's generally a high valuation. They've come down to a little bit more reasonable. Are they reasonable now, given the fears that are there? Can we find an opportunity? That's kind of what we're looking at now. Anything further, or should we just get to Rahil so we can get out
to
of
the
here,
guru,
get some food, get to the guru?
Yeah.
Rahil or the drink? Yeah, Rahil is the guru.
It's
Guru
definitely
Organic
the
Energy
drink.
Corp. Yeah, the drink.
This stock, Guru Energy, still bugs me, Ryan, and I'll tell you why. I have been following this business for a long time. Last year, the stock was trading around $3 pre-earning. Guru dropped outstanding Q3 results. I missed it buying it post Q3 release, and then it ran all the way from $3 to $7 in a blink. I watched it happen live. FOMO hitting harder than a triple espresso. I missed the whole dang move. So it's haunted me ever since. So today I'm diving into Guru with a stone on my heart and a heavy wallet. But you learn, and sometimes you laugh at your own FOMO face.
You have to.
So those who don't know Guru Energy, it's a Canadian beverage making natural, organic, plant-based energy drinks. Basically, the fancy cousin of your average energy drink. Moving on to the history of Guru Energy, the stock went public in September 2020, raising around $34 million by issuing 6 million shares around $5. In the early pre-COVID or COVID era growth push, the stock ripped to $23. Since then, reality set in. By 2024, the shares had fallen to a low of around $1 as investors questioned the path to profitability. Today, the stock has recovered to around $6, reflecting a market cap of over $200 million and a business that has finally started to show some profits. Going through the financial trends, so what changed? The big strategic move was Guru's shift to a direct retailer distribution model in Canada, ending its distribution agreement with Pepsi Company. It gives more control over retail execution, shelf presence, pricing, and inventory, which is already showing up in better gross margins. They generated 71% of gross margins in Q3 fiscal 25, as you can see on the screen, and 65% in Q4 fiscal 25, which is significantly up from prior quarters of Q3 and Q4 of last year. Financially, the inflection has been clear. In Q3 and Q4 of fiscal 25, Guru has delivered record quarters of a revenue of around $10 million in each period, up significantly versus Q3 and Q4 of last year. Also, two consecutive profitable quarters, the first profit since the IPO, with expansion of gross margins and overhead cost sustains, incremental revenues now dropping more meaningfully to operating earnings. Moving on to valuation, on the balance sheet side, the business is trading at 3.9 times current ratio. They have around $28 million of cash sitting on the balance sheet, and have no debt. So the balance sheet has been pretty good. On the income statement side, the company is currently trading at around 5 times sales with no meaningful EBITDA yet on a trailing basis. The company doesn't provide any forward-looking guidance, so I don't have any forward ratios here. Moving on to the bull and bear case, let's run through the bull case. First, I believe Guru is finally proving it can grow and be profitable at the same time with back-to-back record quarters and a clear margin story as the direct distribution model scales. Second, the company is outgrowing the category, growing around 20% versus the broader energy drink market growing at 10%. Third, clean balance sheet, strong cash, no debt, gives them flexibility to invest in marketing and distribution without compromising on profitability. If they can sustain this run rate, incremental revenue could translate into meaningful EBITDA and earnings power over the next few years. Now, the bear case. First, energy drink oil is brutally competitive, dominated by giants like Monster, backed by Coca Cola, Celsius partnered with Pepsi, etc. That kind of competition makes shelf space expensive and drives up customer acquisition costs. Second, Guru is heavily dependent on new product launches to sustain growth. If a wave of innovation misses, revenue momentum could slow quickly. Third, on the cost side, rising aluminum prices can pressure packaging costs, which could squeeze margin if Guru cannot pass the cost through. So, in conclusion, or to sum it up, I personally believe that in the coming quarters, the next two quarters are Q1 and Q2 of fiscal 26. I think they're going to show the revenue growth, and I think they're going to continue with the operating profitability. This is not a financial advice. This is just me doing my personal due diligence and listening to the earnings call, going on Amazon, checking their reviews, and they are doing very well in terms of they had amazing Black Friday, amazing Boxing Day. So today's valuation reflects a business that has transitioned from story stock to a more mature company, a disciplined operator with renewed growth momentum. For now, the setup is pretty clear to me. If management continues to execute, lands more US wins, there is room for upside from here. If innovation stalls or competition intensifies, the stock's history is a reminder of how quickly sentiments can reverse. That's pretty much it on Guru Energy.
Yeah, well done. Yeah, and like that is the
Yeah.
thing, just so much competition. Like as I'm sitting here, what do I have? And this isn't, I'm not paid by Red Bull to show this, but
Their
um,
sales are now going through the roof as
yeah,
Brennan
of
holds
course.
that up. As in real time, you can track that, right?
But I
I want to
recall the
be like
day,
him.
I recall the day where we're in our morning analyst meeting. Rahil's like, saying to Brett and I, he's like, man, I wanted to throw some speculative capital at Guru. And, he was thinking about it. And the following day, the stock was up 50%. Um, but, like you said, Rahil, at least we're seeing, the business is starting to, generate profit. It's trending in the right direction. If you wanted to take speculative capital, that is a better way to go forward, in my opinion. Like I've heard so many people look at like C3.ai Inc. That's like a high flyer. A lot of people are talking a lot about the revenue growth, but if you look at a business like that, we're seeing
No.
operating losses scale with revenue growth. That is a scary combination in a business.
Yeah,
Um,
you want operating leverage.
exactly. You want
That's
operating
obviously.
leverage. It's as simple as that. But like that's the thing. So we'll see, Guru, how they perform. They can
Yeah,
continue
we'll
to
track
ramp
their
up.
profitability. Like to see more profitability because, I mean, based on trailing numbers, it's expensive, but, great balance sheet and there is growth and they look like to be focused on more profitable operations, which you need long term.
I've had their
So
energy
interesting
drinks.
company.
I thought they were
You know
pretty
how
good.
I got introduced to Guru? Because my family every year watches Amazing Race Canada, and they sponsored seasons 8 and seasons 9, 2022, 2023. So that's how,
Nice.
the host, John, whatever, the guy that used to be Skeleton or whatever he was at in the Olympics, but he's holding up a Guru energy drink and everybody's, oh, we love these. So.
Nice.
They sponsored it, but I think they've gained more with their current strategy as opposed to what they were doing back in 2022 and 2023. I think it's a better strategy than just sponsoring Amazing Race. As much as I like the race or the drama.
Yeah,
I hate this drama.
when Rahil brought up the stock price too, going back to kind of like the COVID euphoria, I was just thinking back to that YouTube comment that we got on on my one on GMG there that I was looking at, where it's like, but it was one of the best performers back in 2020. Oh,
yeah.
that cracks.
That was silly season. I mean, you see the volatility of Guru. I mean, 545 IPO to 2348 and then down to 120. I mean, at 2348, it's silly season, and that wasn't really anything that Guru was doing. The entire market was just was silly at that point. But
it's in a better position now in a quarter of the price.
Yeah, isn't that crazy? Isn't that crazy that it's in a way better position now, and the prices? And you can go back and look at many companies that are way better businesses now, and they trade at far lower valuations than they did at that point. So. There was terrible businesses that got valuation at that point. But, hopefully we don't see that silliness, although the market is silly in the near term. So we can get some silly. There's some silliness now, and we'll see it in different sectors. Maybe we're seeing that partially in the metal sector, but we'll see a year from now where the prices are. I think that's going to end off our show for this week. Good job, gentlemen. Keep your questions coming into Your Stock, Our Take segment, and we'll endeavor to answer those on a weekly basis. If you're watching this right now on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcasts, rate and review us. And as always, we wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.
Thank you.